Here's a sentence that would have gotten you laughed out of a Davos panel 10 years ago. China's growth model might actually be broken. Not slowing. Not rebalancing. Broken, in a specific mechanical sense this episode is going to walk through from the ground up. This year's second quarter GDP number released a week ago came in at 4.3%, the slowest pace in 3 years in an economy that spent 3 decades training the entire world to expect numbers that started with an 8 or a 9. Home prices have been falling for 4 straight years. One of the country's largest developers just said its losses are still widening. A private equity firm is dumping Beijing real estate at a loss this week, right now as this script gets written. None of this is new information if you follow financial news. What's actually missing from most of the coverage is the mechanism. The specific machine that turned sell some land into a $5 to $13 trillion question nobody can even agree on the size of. This episode builds that machine from scratch because everything this show has said about China until now, Treasury seller, gold accumulator, BRICS architect, has treated it as a geopolitical actor working from a position of strength. This episode asks what it looks like from the inside, where the position is considerably more complicated. To understand what's breaking, you need the model that worked for 30 years first because it wasn't an accident and it wasn't corruption in the simple sense. It was a deliberate fiscal design with a specific foreseeable failure mode built in from day one. In 1994, Beijing centralized China's tax system, redirecting the bulk of tax revenue to the national government and leaving local governments, who still had to pay for roads, schools and everything else, with a funding gap and very few tools to close it. Footnote 1. Local officials found one. They couldn't borrow directly, but they could sell land use rights since all land in China is state-owned. Land sales became the single largest revenue source for most Chinese municipalities, and property development became the engine that generated the land value in the first place. A genuinely elegant, self-reinforcing loop, right up until it wasn't. The developer side of that loop ran on a mechanism called pre-sale financing. Developers sold apartments to buyers years before construction finished, using buyer deposits, not bank loans, not their own capital, to fund the building. This let developers operate with extraordinary leverage, expand into dozens of cities simultaneously, and kept local land auctions bidding wars hot, which kept local government revenue flowing. It worked as long as home prices kept rising and developers kept building fast enough to stay ahead of their own pre-sale obligations. In 2020, Beijing tried to cool this down with a policy called the 3 red lines. 3 leverage ratios developers had to meet to keep borrowing freely. It was meant to be a controlled deflation. Instead, it triggered a liquidity crisis at China Evergrande, the country's most indebted developer, which formally defaulted in December 2021 and is still working through Hong Kong court liquidation proceedings as of this year. Proceedings complicated enough that reports this June described PwC partners connected to the case reportedly taking personal legal precautions of their own, which tells you something about how contentious the asset recovery fight has become. Footnote 2. What followed wasn't contained to one company. Goldman Sachs now estimates Chinese home prices have fallen roughly 20% over 4 years, with the correction likely continuing another 10% before finding a bottom around 2027. A decline the bank's own analysts describe, without hedging, as one of the decade's most significant economic events. Footnote 3. This year's numbers confirm the correction hasn't stabilized. Fixed asset investment fell 5.7% in the first half of 2026 alone, and China Vanke, a developer widely seen as safer than Evergrande, given its historical ties to state-backed shareholders, said this month its own first-half loss may widen to $2.2 billion. Footnote 4. An Atlantic Council analysis this year cited an estimate that as many as 80% of China's developers and construction firms could exit the market entirely in the coming years as the industry undergoes what amounts to a permanent contraction, not a cyclical dip. Footnote 5. It's worth being precise about scale here because property crisis undersells how central this sector actually was. At its peak, real estate and related construction activity accounted for roughly a quarter of China's entire economic output. Not a sector experiencing a correction, but close to the single largest sector in the world's second largest economy undergoing one simultaneously. Here's where the sourcing gets genuinely difficult, in a way worth being honest about rather than smoothing over. Local governments never stopped needing money once land sales collapsed. They just move the borrowing into entities called local government financing vehicles, nominally private companies that borrow on a local government's behalf without technically counting as government debt. Nobody agrees on how big this actually is. China's own central bank governor, Pan Gongsheng, has pegged LGFV operational debt at 14.8 trillion yuan. The IMF's estimate, cited in the same reporting, runs to over 4 times that figure, nearly half of China's entire GDP. Footnote 6. Following this show's own sourcing conflict standard, the more traceable, specifically attributed figure is the central bank governor's own number. The IMF's dramatically larger estimate is flagged here explicitly as a competing figure from a different methodology, not blended into a false middle number. Either way, this is debt large enough that even the disagreement about its size is itself a systemic risk indicator. The demographic layer compounds this rather than sitting beside it. China's population began shrinking in 2022, the first decline in 6 decades, and the working-age population actually peaked years earlier, around 2015. This isn't a slow-building future concern the way it partly still is in the US, as this show's last episode established. It's already load-bearing on the property correction itself. Fewer future households means fewer future buyers for a housing stock that was, by some estimates, already built out for a population larger than China will ever have again. Here's the human scale reframe this section needs. Because of the pre-sale system Section 1 described, millions of Chinese families paid deposits, often their entire life savings, for apartments that, when developers ran out of cash mid-construction, simply stopped being built. Buyers who did nothing wrong are left holding mortgage payments on homes that may never exist, a direct, personal version of the systemic story playing out in aggregate GDP figures. There's a related asymmetry worth sitting with, because it's easy to read this as a story about developers and local governments and miss where the actual pain lands hardest. Real estate makes up an estimated 60+% of Chinese household wealth, roughly double the comparable US share. Footnote 7. That means Chinese families didn't just watch this sector correct from the sidelines the way a diversified Western investor might have. For most of them, the home was effectively the retirement plan, in an economy that has historically offered a thinner state pension and social insurance system than most developed peers. That's not incidental to the demographic story either. A shrinking, aging population with less home equity to draw down than it expected on paper is a second, compounding drag on the exact domestic consumption problem Section 3's 4-lever review is about to run into headfirst. The comparison everyone reaches for here is Japan's lost decades, and it's worth complicating rather than accepting cleanly. Japan's demographic decline was genuinely gradual, unfolding over generations with a mature social safety net, a floating currency that could absorb some of the adjustment, and a large net creditor position with the rest of the world. China is compressing a comparable correction into a much shorter window, with capital controls that limit how the currency can adjust, a social safety net that remains thin relative to the economy's size, and, the part Eurasia Group's research flags as the sharper divergence, a policy response leaning on export-oriented manufacturing rather than domestic demand, flooding global markets with EVs, solar panels, and steel at prices that are drawing tariff retaliation rather than absorbing the domestic slack. Japan largely managed its correction inward. China, so far, appears to be managing part of its correction outward, onto everyone else's market share. There are 4 conventional levers here, and each one runs into the same wall from a different direction. A full bailout of the property sector. This is the option a Western economy would likely reach for first, and it's the one Beijing has been most reluctant to use. Xi Jinping's own framing, "Houses are for living in, not for speculation," a phrase he first used at the Central Economic Work Conference in December 2016 and repeated at the 19th Party Congress the following October, isn't just rhetoric. Footnote 8. A full bailout would mean rescuing the exact speculative excess the government spent years publicly denouncing, rewarding the developers and investors who over-leveraged the hardest. Letting developers fail and restructure cleanly, Western bankruptcy style. This runs directly into the pre-sale buyer problem from Section 2. A clean corporate restructuring doesn't unstrand the families who already paid for unfinished apartments, and the social instability risk of mass homebuyer protests is treated by Beijing as considerably more dangerous than the financial risk of a slow-motion correction. Boosting domestic consumption directly, pensions, healthcare, unemployment insurance, reducing the incentive for households to oversave. This is the fix most Western economists recommend, and it's also the one that requires exactly the fiscal resources local governments no longer have, because those resources used to come from the same land sales that collapsed in Section 1. It's a genuine catch-22. The fix for the growth model requires money the old growth model was the only thing generating. Currency devaluation, to make Chinese exports even cheaper and directly boost the manufacturing side of the ledger. This risks the capital flight China's reserves have already been managing since the mid-2010s capital control regime went into effect. And, given the EV and solar overcapacity already drawing tariff responses from the US and EU, would likely accelerate exactly the trade retaliation Beijing is trying to avoid. Every other locked room this show has opened has been a room behind a door, something an actor built, defends, or gets trapped inside. This one is structurally different, and worth naming as such rather than forcing it into a shape it doesn't fit. Property and land sales aren't a policy choice sitting inside China's economy, they're load-bearing for the walls around them. Local government finance, the household wealth concentration Section 2 already quantified, and the loan books of the banking system that financed all of it. Every door has a locked room behind it, except this one doesn't open into a room at all. It opens onto the load-bearing wall. You don't get to redecorate a load-bearing wall. You get to prop it up indefinitely or find out in real time what happens when you don't. This is where the earlier episodes in this show's arc stop being background and start being the same story from a different angle. Episode 4 covered China's structural treasury divestment and 17 consecutive months of gold accumulation as a geopolitical positioning story, competing with the dollar, hedging against sanctions risk. Worth reconsidering here. Some of that diversification almost certainly is strategic positioning. But a government managing a slow-motion domestic debt correction, thin fiscal headroom, and a currency it can't let float freely also has entirely separate, purely defensive reasons to want assets outside its own strained financial system. Those two explanations aren't mutually exclusive, and this show shouldn't pretend the geopolitical framing was the whole story. The export overcapacity thread from Section 2 is the more immediately consequential one, because it's actively reshaping trade relationships in real time. Manufacturing overcapacity in EVs, solar, and steel isn't a side effect of the property correction. It's Beijing's chosen offset for it, and flooding global markets with underpriced goods is already drawing tariff walls in the US and EU that didn't exist 5 years ago. The mechanism worth naming plainly: when a domestic market can't absorb what state-directed investment has built, and household consumption remains structurally weak for the reasons Section 3 already established, the output has to go somewhere. And somewhere has increasingly meant everyone else's market share, at prices domestic producers elsewhere can't profitably match. That's not a hypothetical dynamic. It's the specific complaint behind the tariff escalations already in motion, and it's the same overcapacity problem underneath both the solar panel disputes of the past several years and the newer EV-specific tariff walls now going up in sequence across multiple trading blocs. That response isn't confined to Washington and Brussels either, which is part of why it's worth calling a genuinely global reaction rather than a U.S.EU story with China on the other side of it. Brazil imposed anti-dumping duties of $322 to $642 per ton on Chinese cold-rolled steel in February 2026 and has been raising its EV tariff on a schedule toward 35% this year. Turkey followed in June 2026 with its own anti-dumping duties of 22 to 32% on Chinese cold-rolled, galvanized, and pre-painted steel. Footnote 9. Neither country is a traditional rival to Beijing the way Washington or Brussels are cast in the usual telling. They're import-competing economies responding to the same underlying arithmetic. That widening matters for the trigger condition below. The more of the global market that closes its doors to the overcapacity, the fewer places are left for it to go, and the more the pressure this section has been describing funnels back toward the domestic system Section 3 already flagged as fragile. That trade friction sits directly upstream of a topic this show has already flagged and deliberately set aside once before: chip export controls and the broader U.S. China technology competition, excluded from episode 10 specifically to keep that episode a financial mechanism rather than geopolitical policy story. This episode is what that future episode was actually waiting on. The domestic economic pressure now visible in the trade and manufacturing numbers is the context a chip controls episode needs to land as more than a policy explainer. A chip export restriction lands very differently on an economy running a comfortable surplus than on one leaning on manufacturing exports specifically because its domestic engine has stalled. And that distinction is exactly the kind of mechanism-first grounding this show's foundational episodes exist to provide. The specific trigger that would justify returning to this material as a current concern episode, rather than revisiting it on a schedule. A major LGFV or developer default large enough to move markets outside China, a break in the currency's managed peg, or a sharp escalation in tariff retaliation tied directly to the overcapacity story this section just laid out. None of those have happened yet. All three are more plausible this year than they were 2 years ago. None of this is a prediction that China's economy collapses on a specific date. That's not a claim this episode is making, and it's worth saying so plainly. What this episode is claiming is narrower and honestly more useful. The load-bearing wall Section 3 described isn't going anywhere on its own, and every lever Beijing has left to manage it costs something specific, visible, and politically expensive. There's a version of the next chapter in this story that's still being written in trade negotiations and tariff schedules rather than GDP reports. That's next.